Up next, super excited, we have Anna Barber, the managing director of Techstars LA. She's going to run through an incredible, oh, hey, Anna. Incredible presentation about Fundraise Faster. And yeah, perfect timing. I will pass it on to you.
Awesome. Hey, everyone. So guess what? It's my birthday.
Happy birthday.
Yeah, I'm actually, and like I always out myself, I'm 51 today. So if anyone wants to talk to me about what it's like to be an old lady in tech, I'm happy to talk to you about that.
Don't look a day over 30.
But so I heard a little bit of the talk this morning, some great tips this morning in the morning session about fundraising. I'm going to talk like really tactically about kind of how to set up your process for fundraising. So I'm going to share my screen. I'd like to just say hello to everyone all across the country. And I hear there's some folks in Europe as well tuning in. So that's terrific. And look forward to seeing your questions. And so I'm going to spend about 15-20 minutes just going through this deck really quickly, and then happy to dig into questions and also answer questions afterwards via email, or via Twitter. Lucas, thanks for organizing this. It's a really great format, and excited to be here today. So let's see, I'm going to figure out how to share my screen here. Here we go. Okay, share that. Okay, so now I need to go into presenter mode. Let's see. Okay, so just a little bit about Techstars, and me. So I was a founder myself, was an early employee in product at a couple different companies, also was a founder, raised money, scaled a company, sold it. I also have a background at McKinsey and was a corporate lawyer. And now, what I love to do and what I devote myself to is helping build the LA tech ecosystem and just generally supporting early stage founders. What is Techstars? I run the Techstars LA Accelerator. Techstars is the worldwide network that helps entrepreneurs succeed. It was founded in 2007 in Boulder, Colorado by David Brown and David Cohen before there were any accelerators. And they wanted to find a better way to help founders other than just writing them checks. So they were one of the first entrants into the kind of accelerator ecosystem, which is so much more well developed today. Today we have a presence. This is everywhere Techstars has a presence around the world. So these are where our accelerator programs are, where we have offices, where we run startup weekends, where we have startup weeks. So it's pretty exciting to see that global footprint. So what is Techstars exactly? It's a mentorship-driven 12-week accelerator program. We've got 46 programs around the world right now, each serving 10 companies at a time. So it's a very small boutique strategy. We have 1,800 companies in the portfolio that have collectively raised $5 billion, 165 exits, and 18 billion market cap. 90% of our portfolio is active or acquired. And when you consider the fact that 90% of all new companies that are started end up not succeeding, we're pretty happy with that statistic. Let's see, how do I, so what do we look for? We're stage agnostic. We tend to invest in companies that have a product in the market, something that they can commercialize, but don't necessarily have to have product market fit. They may have revenue, they may not have revenue, they may have raised money, they may have not raised money. We're just really interested in founders that want to dig in and spend 12 weeks focusing on how to grow and build the foundation to have a successful company long term. So that's a little bit about Techstars. Happy to talk more about Techstars. And now I'm gonna just walk through kind of a process and approach for fundraising. So the more organized you are about your process up front and the more work you do ahead of time, the more likely you are to be successful. You should expect this to take 5 or 6 months, and you should expect to take the first month to kind of set up the process before you hit the go button and officially say that you're fundraising. And so it's just important to understand it's going to take you a length of time. I heard someone say this morning in the session, you should expect to talk to 75 investors. I've actually seen teams that had to talk to over 200 investors in order to close a successful round. And those teams ended up with great lead investors and a great round. It just took them a long time to find the right fit. So just know as you're going into this that this is a process and it's going to take time. So the next question is kind of, how much money do you need? And founders tend to approach this question from the perspective of what am I going to spend it on? I need to hire this person and that person and have a marketing budget, and this is going to cover our runway for 6 months. So founders tend to think about this number from the cost side. I really want to stress that you should be thinking about this number in terms of where is it going to get you. So the amount of money that you're raising, when it runs out, it'll leave you in one of 3 situations. Either it will get you to the traction that you need, it'll get you to profitability, which is great. It'll get you to the point that you need to be at in order to raise your next round, or it won't, in which case, your company may be dead. So you have to think about your fundraise in terms of what do you need, assuming you're going to raise another round of capital, what do you need to show to raise that next round of capital? So if you're looking at a seed round, you need to be planning for the Series A round before your seed round, because you need to understand what are the metrics your Series A investors are going to want to see. And therefore, how big does your seed round need to be in order to get you to that next milestone? And a related point to that is your seed investors want to hear not how you're going to spend the money, they want to hear what milestones you're going to reach. Because what they're thinking in their minds is, how is this going to de-risk the business? How much are you going to learn with this money? And how far down the road is it going to get you? Then the final thing is, a lot of founders like to go out with saying, oh, I'm raising, $2 million at a $6 million pre or whatever. I just encourage people not to set the terms of the deal up front. The market will set the terms. So your job is to tell them how much money you need and what you're going to do with it and what you're going to be able to accomplish it. The investor's job is to, make you an offer that's going to determine what the terms of the deal are. In terms of where you get your money, we're really focusing here, because this is about venture-backed startups, on friends and family angel investors and VC, not talking about bank financing and crowdfunding. Although I will say, one really interesting thing, I was speaking to like a top Silicon Valley Series A investor yesterday, and someone asked him this question, and he said he really, is totally fine with having crowdfunding on someone's cap table, which I thought was great to hear, because as recently as 3 or 4 years ago, it was sort of considered, not as quality funding, to have gotten funded on a crowdfunding platform. And I think that is no longer true. And that's really great, because I think it's a fantastic source of capital, particularly if you have a product that your public or your audience might want to, also invest in the company. It's a great way to go, because a kind of double win of getting in front of customers and then also getting your customers to become your investors. So let's see, Lucas, are there any questions? Should I stop and take questions, or should I keep going?
I think keep going for right now. Typically they start asking questions at the end.
Okay, fantastic. Okay, so now we're just going to talk about the nuts and bolts of like, what is the stuff that you need in order to fundraise. So to get the process started, you need your deck, an executive summary. Some investors hate executive summaries. They will only take a deck. I actually heard an investor say they won't talk to someone who sends them an executive summary, which I think is ridiculous, but never mind. You need a set of financial projections, and obviously all 3 of those things have to speak to each other. The numbers all have to fit across those 3 things. So you kind of have to build the whole system before you even get started. In general, DocSend is fine. If there's an investor who wants you to send a PDF and doesn't want DocSend, send them the PDF. Don't be precious about it. Do it the way they want to do it. It's great that they're asking to see your document, so go ahead and share it with them. The second thing is diligence. It's always great when you can pull this together beforehand. Like an early stage company that has a data room is going to really wow your investors. If they're serious and they're digging in, and you can invite them to your data room that has things like your organizational docs and your cap table and maybe some great customer testimonials, that is always an amazing thing to do to really impress them with how buttoned up you are. And that can be on Google Drive or Dropbox. And then, you know, in terms of legal, the earlier you get your attorneys involved in this, and, you know, even having them review your marketing materials up front, the more prepared you can be. So that first month, to go back to the calendar, you're going to spend your first month of your process kind of lining up all these documents so that you're ready to go. Okay, so like what's in your deck? I think that, you know, this is sort of pretty well known and pretty well covered out there. You know, you want to cover all these things, but I would say that this outline is a starting point, and I would sort of use it like a recipe and then kind of make it your own. Just like when you're cooking, you're gonna like add your own flair to the dish. Like you don't want to just march through this. You want to make sure that the narrative actually works for you and your company. And what is most important is that you're telling a compelling story. When I write a deck, what I like to do is actually write the headline of the deck. So like this is what we did at McKinsey. We were like professional PowerPoint writers. You know, so you write the headline and you make sure all the headlines that of your deck kind of link through into a narrative story, and then you go and fill in the visuals on the slide to support the point you're trying to make on the slide. So the outline's helpful. You kind of need to make sure you cover all this stuff, but do it in a way that tells a narrative story that's going to be effective from a storytelling perspective, and practice sending it to people. See if it's telling the story that you think it's telling. You get so close to your own story that it's sometimes really hard to see if it's actually coming through. And then you have two decks. You have the email version, which is shorter and probably has fewer of your proprietary numbers in it. And then you have the deck that you deliver in person when you're sitting with them that might have more detail in it. And either way, less than 15 slides. Anything more than that, and you're not going to get value out of it. Okay, so this is important that you really need to have an investor target list, and you need to work on this and have this all set up. So, and it takes a lot of research to identify who are the right investors. So everyone who's on here, you need to know how good of a fit are they? Do they invest at your stage? What's their typical investment? Have they invested in any companies in your sector? How are you going to get to them? Who do you know who knows them? You know, so this will set you up for all of your outreach that you're going to do when you kind of press go and you start your process. I recommend kind of thinking of investors in like 3 tiers. So like A, B, and C. So like A is your absolute dream investors. B is the people that you're excited about, you know, but might not be in your top group, but you feel comfortable, maybe you have a personal connection. And then C is like either you're not sure about fit or you don't have a personal connection. And then when you're going out to pitch to people, I recommend going B, A, C. So you don't want to start with your A's because you're still kind of working out the kinks of your pitch. You would like to set up meetings with your B group first. Because then if you're walking into your A's, you might have some funding already circled. And then it's great to be able to go into those meetings with your dream investors, having practiced your pitch a little bit, and also being able to say that you already have someone else who's committed. I can share this, and there's also a great post on kind of how to do this by Alex Iskold that's available on his blog. So that's another great research. And then in terms of reaching out, so if you imagine that process again, you've got your 1 month of prep. You want to do all your reach outs at the same time so that you can set up a bunch of meetings in a row, and you can create for yourself, you know, and for the investors a feeling of momentum. You know, and I think the main value for this is for you when you go into the room, you feel confident and excited knowing that this isn't the only meeting that you have, because you have a lot of other meetings that you've already booked. So you want to go to your personal contacts, and, you know, maybe some of those people are in your investor B group and you feel really comfortable with them, and you can go to them first, then the warm intros, and then after that, the cold outreach. One thing that's really great is that I'm seeing a lot of people write about this online, you know, and also was talked about this morning, is like people are not as reluctant anymore to accept cold intros, because we all recognize that, you know, not everyone has a network, and that we want to broaden the availability of venture capital to people beyond people that we already know. So don't be afraid to send a great cold email. Just make sure it's really personalized, and focused to the person that you're sending it to. And so what are some other resources? There's a book called Venture Deals, which was written by Brad Feld and Jason Mandelson. They also run Venture Deals as a free online course. I think it's like in the middle right now, but they run it at least once a year. And it basically walks you through all the ins and outs of venture financing from a legal and tactical perspective. And then, here, a plug for apply to an accelerator. There's a lot of great, accelerators here in LA and involved in this conference. And, there's many great choices. And it's certainly the fundraising process and how to fundraise effectively is certainly something that, we cover in an accelerator and, any of the accelerators would cover. So that's that. Here's my email. I think you guys can see this. Feel free to reach out to me if I can't answer your question or you don't have time. I will definitely get back to you and, help you get to the right person who can answer your question. So let's see, that's it. Now, how am I going to get into these questions here?
I can ask you them.
Okay. Awesome. So let me stop sharing my screen. And then, okay.
Thank you so much, as always. Hi. So first question, what does Techstars look for in a portfolio company?
Oh, that's a great question. So it's also really hard to answer. We have 46 programs around the world, each investing in 10 companies. And so there's a really wide variety, in the portfolio. So I would say it's less around vertical because we've got a space just here in LA. If you just look at LA, we have Techstars Space, which is investing in aerospace companies, Techstars Music, which is, technologies in and around the music industry. And then Techstars LA, which is, anything goes. I've had everything from aerospace, data and aerospace data and analytics to a company making men's shoes. So really about what the company does. I would say more about kind of culture. For founders who, have good founder market fit, who are passionate, who have a learning mindset, who've shown resilience and grit. Like, when we invite a company to be part of Techstars, we're inviting you into our global network, like essentially into like our family. So we look for people. I personally look for someone that I want to work with for the next 5 to 10 years and potentially, be part of my life for like, the rest of our lives, right? So it's a very personal decision, and it has a lot more to do with who you are as a person and a human and why you're doing the company that you're doing than any kind of other metric.
100% agree. I think that a lot of people overlook the likability thing and don't really think that like we're stuck with you for a very long time. It's something that they don't take into account a lot of the time. So I'm glad that you brought it up. First off,
and one of the things that I actually ask myself is, would I be willing to go work for this person, right? And that's a really interesting test, right? And I want to be able to answer yes. Oh. Any one of my portfolio companies, I want to be able to say, I would be comfortable going and joining your team and working for you.
No, it's a great litmus test. I really like that one, actually. I'm going to start thinking through that one. Would be interested to hear more about your background and how that affects what you look for in an investment.
Oh, that's so interesting. Okay. Yeah, people ask me about career path a lot just because I have a very circuitous and strange career path. So I started out as a corporate lawyer, and then, I realized pretty quickly that if you're doing law, it's very hard to add value to the business transaction, but it's kind of easy to screw it up. So, the main business terms are already done. And I felt like, how am I going to have an impact? I didn't feel like I was well positioned as an attorney to like really have a big impact. So that's why, when I was given the opportunity, I went to McKinsey because I thought that would be great business training. And then somebody said, come work at a startup. So I did that. So, my whole career has sort of been following the crumbs of just different opportunities that appeared in my life and following my curiosity, I guess, for lack of a better word. And that's really how I approach investing too. When I meet someone who's really passionate about what they're doing and they're able to convey their own passion and excitement and get me excited about what they care about, and I start to think, oh, I could learn a lot. I'm excited to learn more and I want to learn more. That's really the main thing that I look for. And that's my approach to investing. So I used to worry that, oh, I don't have a solid enough investment thesis, or I need to, be more specific about what kinds of companies. But, but I have found that by sticking to my gut instinct and following my curiosity, it's led me to be able to work with some really amazing people. And that's really what I care about. So I guess like the pattern of my life, or kind of the one through line, is kind of like, always be learning and always stay curious. And, that's how I approach investing too.
No, that's exciting. It's a great methodology to live by. Let's see. You've invested in a lot of different sectors. You said aerospace, shoes, so very broad spectrum. Is there any sector that you personally are excited about right now?
Yeah, so I do have a couple of things that I tend to invest in over and over. So one of them is retail and e-commerce. Okay, so we're here in LA. We have a lot of retail, e-commerce, CPG, logistics, like that kind of entire supply chain. So like one of the investment theses that I have that I'm excited about is companies with enabling technologies for direct-to-consumer brands or retailers to do things better in the way that Amazon does them. Right. So if you think about the Amazon ecosystem, it's everything from using artificial intelligence to predict what we want to buy, to making it easier for us to check out, to making it easier for us to reorder, to streamlining delivery and making delivery instant. So if you look at the things that I've invested in, in Techstars LA, a lot of them are kind of disrupting e-commerce and retail. So there's Shipsy, which is bringing smaller retailers the ability to do just-in-time delivery, so that a small mom and pop shop could offer 1 hour delivery in their e-commerce shop. There's Furnish, which is offering the opportunity to get furniture with a totally different business model by subscribing to it instead of buying it, which I think is really fascinating. There's Prism, which is a company that's helping direct-to-consumer brands solve the replenishment problem by allowing people to reorder their products easily via text message. And there's just a ton of really interesting companies kind of in this space in LA, and it's an area that I'm really excited about.
Awesome.
Yeah. The other things that really excite me are just like innovative applications of artificial intelligence, particularly for like enterprise software. Anything that's like disrupting an industry that hasn't been tech friendly. So there's a company, Direct Tech Labs, that's creating a retention platform for the direct selling industry for multi-level marketing here in LA. Really, interesting company. I love that because direct selling is an enormous industry that has very little technology associated with it.
Mm-hmm. Nice.
So those are some themes.
Perfect. Next question. Is it seen as a negative if a founder has a full-time job during the bootstrap and pitch process phase? The hope is that they would close capital before leaving the job.
Yeah, that's a great question. It's a really tough chicken and an egg problem, right? Because the concern is that the investor is going to think you're not committed, right? And your concern is like, I need to, put bread on the table, right? I have to have a salary. I've seen it work both ways, actually. So Techstars starts on July 15th. I've got 2 different companies whose founders, were in serious jobs before this. One of them, actually, this is a great story. So one of them, she's working in this, pretty high-powered job in finance. She's got this startup, got a family. And I'm going, this is cool, but like, is she serious? Let's wait and see what she does. 3 weeks later, she comes back to me. I quit my job. I launched my product. I got my first customers, and like now we have a wait list. And I was like, whoa, okay, she's serious.
Wow.
She meant business. She just jumped off the diving board into the deep end of the pool. And she's gotten a great reception from investors and just has a lot of momentum as a result. The other one, 4 founders who spent the past 18 months slowly building their company in the evening. They have revenue. They just raised money while they were all still at their job, but they said to their investors, hey, we're going to quit. Here's our plan. We're going to do Techstars. We're all planning on quitting our jobs on X date, and look how much we accomplished, even just moonlighting. Imagine what we can do when we're working full time.
Yeah.
And that was also really persuasive. And they laid out a plan for how they were going to do it, when they were going to leave their jobs. So I think it's totally fine to do it. You have the burden on you if you are working while you're bootstrapping your startup is you got to be able to show traction and progress. You got to be able to show that you're making progress, because that's how people are going to know you're serious.
Nice. How do you, I think I get this question a lot, especially with traction. Like how do you define traction? And what is the best way for an entrepreneur to understand what something would be considered so they could take that next step for trying to get funding?
Right. So traction has to be related to something that's evidence of product market fit, right? So whatever you're using as your key performance indicator to show traction, it has to be directly related to your customers love your product. Okay. So for example, what is not traction is, our customer acquisition cost is really low. We got new people to download our app, for 10 cents each. Because the next question is, okay, are they using it and how long do they stick around? So that's not showing you can spend money and acquire customers is not traction. Traction is engagement. Even if it's small, like really high engagement on a small base is traction. Really high retention on a small base is traction. It's anything that's evidence. I think about it as evidence. So it's not necessarily moving you towards profitability. It is de-risking your idea to show that it's moving towards product market fit.
Awesome. That's a great one. Let's see. Who are you excited about out of the last portfolio class that you had, I believe, last year, if you're starting a new one, July 15th, right?
Yep. Oh my gosh, I'm excited about all of them. I have portfolio companies, and I love them all. But Furnish is one that I mentioned. Furnish is doing really well. They're getting a lot of press. They're growing fast. From my first class, there's Slingshot Aerospace, which is the satellite data and analytics company. Like they just closed a really nice round. And what I love about that is like those two companies sort of show the two sides of LA, right? The deep tech side, the Slingshot team all came out of the Air Force, and they're back doing deals now with the government. And Furnish is obviously a consumer kind of, new economy, like in the same category as sort of Clutter Enjoyment and all those other great LA companies. So I would say those, but most of all, I'm just really excited about the LA, tech community in general. And I think there's so many exciting companies. I think one interesting thing here is, of the companies that kind of made it to the last round for my program, I have my 10, and then 3 other of those companies actually got picked up by other Techstars accelerators in other parts of the country.
Oh, nice.
To me, says something about our community and our ecosystem here in LA, which is that like we have a really strong talent pool here, and there's just a lot of great companies, coming out of this market. So it's exciting to see all these new resources, coming up for founders as well.
Awesome. Well, we have about 1 more minute. Any final thoughts before we have to let you go celebrate your birthday?
Yeah, I was talking to a founder this morning. About fear. And I was telling her this story about, relative to this question of leaving your job, it's like, I sort of make the analogy, it's not the most complimentary analogy to people who work in big companies, but bear with me. It's kind of like being in the zoo versus being in the wild. So like when you're inside a big company, like you're in the zoo, it's safe, you're going to get fed every day, right? When you're in the wild, like you don't know when you're going to get fed, but it's way more exciting, and it's very hard for people to kind of leave the zoo and go into the wild. And I think that, there's a lot of fear associated with being a founder, and to kind of like look that in the eye and recognize it and accept it and do it anyway, like that is the emotional journey of being a founder. So, all this tactical stuff is great, but I think it's also important to recognize that there is, there's an emotional journey here that we're all taking in order to do this work. And it's one of the reasons why community is so important, right? So the community that you're a part of, you know, and the support that you can get from people that are on the same journey, like that is what's going to help you get through it. So.
Agree 100%. Again, Anna, thank you so much for jumping on today. We really appreciate the insights.
Yeah.
And then they want to know deck-wise, if you can share that.
Yeah.
If so, then yeah, I'll get it out to everyone, and it'd be perfect.
All right. Thanks a lot. Thanks,
Cool.
Lucas.
Thank you again, Anna.
Okay. Bye.